Hello, and welcome to Portfolio Matters Weekly Markets Checklist, week 200. My God. But
Well,
before we get into it, Richard will read the disclaimer.
thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What have we got this week, Keith?
Lots going on in the world, Richard. So, first of all, the news. Well, the US government shutdown ended last week after 43 days, making it the longest one ever, after 8 Democrats crossed the floor to enable a budget to be passed. Um, Now, it was a bad week for gilts last week after the FT reported that Rachel Reeves had shelved plans to raise income taxes in the budget this Wednesday. And markets felt they had been misled by her previous statements about, or previous rumours that she was going to be fiscally responsible, and that prompted a sharp sell-off in sterling and in UK gilts. In Japan, the Japanese economy contracted at a rate of 1.8% annualized in Q3, and the new Japanese Prime Minister has unveiled a $135 billion stimulus package to try and raise the economy, and that will add to an an already enormous Japanese debt pile, causing a sell-off in Japanese bond yields and the yen to fall. We have some charts for you in a bit. And finally, the US has issued Ukraine with an ultimatum to either accept its peace proposals or it will stop receiving military aid. Now, that has caused a sell-off in oil prices as the market anticipates an end to sanctions on Russian oil and more oil flowing into an already flooded market. Market news, well, equities have had a bad couple of weeks. Mega cap tech stocks are now down 3 weeks in a row. In absolute terms, the fall in shares is quite small compared to the size of the run up over the last year or couple of years. But the crypto market has properly crashed. Bitcoin is down 19% over the past couple of weeks and down on the year, and 1.2 trillion has been wiped off the market cap of crypto assets in the past 2 weeks. Oil fell. Industrial and precious metals were weakish, but pretty resilient, really. Okay, some charts related to the news. Well, this is gilt yields. Generally, around the world, government bond yields have been flat to downish over the past couple of weeks. We've got charts for you in a bit, apart from in the UK, where they've had a bad couple of weeks. This is gilt yields on the 10th of November after the news of government U-turn on income taxes causing a sharp rise in the 10-year. Now, the trouble is the OBR estimated its borrowing costs using the blue window here when gilt yields were coming down on the basis that Rachel Reeves had seemingly committed to raising income tax and being fiscally prudent. And then once the OBR had calculated the its fiscal forecast based on these lower gilt yields, she promptly changed course, sending gilt yields back up. Question mark. Did she game the OBR? Well, be afraid for this Wednesday, folks, when the budget is announced. Although, actually, once again, I would probably be ignoring what Rachel Reeves says and waiting until the OBR forecast come out for what their assessment of what she's done is. But already we have one of the worst and most complicated tax codes in the world. This is the Tax Foundation's rankings of tax competitiveness. There we are, right down the bottom. The only good news is we're better than France and Italy.
It makes you think, doesn't it? In one fell swoop, I'm sure you could address a lot of the productivity issues of the UK by shifting us from where we are to, let's say, somewhere around Czechoslovakia, Czech Republic, Sweden, Turkey, Australia-ish. You know,
Yeah.
that would be a good project for any government to undertake.
Well, just look at Switzerland, fourth from top,
Yeah,
you know, consistently strong, well-run economy.
precisely.
You'll notice that the US is much better than we are.
Yeah.
And, I think after Wednesday, Richard, bet on how low we'll go on this chart. Now, 73% of the UK population thinks the government has handled the budget badly. So odds on,
Could we just go back to the chart and
yeah,
be a
sure.
glass half full, Keith? Because we just need to be a bit more positive. 2%, 2% thought they handled it very well.
Yes. Is that what is the population in UK asylums, Richard? Must be.
N plus one, Keith.
So, uh, the odds of a Fed rate cut next month have swung around a lot over the last couple of weeks, but the market is now betting that the Fed will cut rates again next month after some dovish speeches by Fed governors late last week. Turning to Japan, well, the market has not taken the latest um, fiscal stimulus package of 135 billion very well. The yen has fallen, and the Bank of Japan is threatening to intervene if it goes above 160. And you'll see it's kind of set that ceiling the last couple of years. Watch this space. Bond yields, 30-year hit new highs. And Richard will like this chart. So the blue line is Japanese 10-year yields now. The orange line is the 10-year forwards. So it's where markets expect the 10-year to be in 10 years' time. So essentially, the bond market is anticipating a continued dramatic rise in Japanese bond yields, which will set up either a debt or a currency crisis. Watch this space. Japan is running out of space to fix this problem. Nvidia beat forecasts and raised its revenue forecast for 2026, but you'll notice that revenue growth is set to slow to just 14% next year. Its revenues are now 200 billion per annum and still growing at 60%. Amazing. But sales growth has slowed a lot, although it remains 60%. If AI investment forecasts are right, then its revenues will keep on rising. We've got more on this later, whether these are remotely credible. But as I said, mega cap tech stocks have had a bad 3 weeks, though, down 3 weeks in a row. And a sign that some of the irrational exuberance may be coming out of the market. Crypto has fallen sharply, and the meme stocks have halved in what's that, 3 weeks? So this is the meme ETF that looks at high volatility popular stocks, and crypto market cap down 1.2 trillion from its peak. So quickly, what do we know about the forthcoming UK budget? Well, the problem arises because despite Rachel Reeves saying that she was going to do a one-off tax rise last budget of 40 billion, it has not turned out to be enough. What's happened is that gilt yields have risen as the market has lost faith in the government. Remember this time last year that Rachel Reeves stood up, delivered the budget, and failed to announce to the government or the people exactly how much she was raising spending. And it was only when the OBR then published its announcement that gilt sold off sharply. So the OBR have downgraded UK productivity forecasts, and that is forecast to leave a hole of 20 billion that she will need to fill to meet her fiscal rules by the end of this parliament. The government has also U-turned on welfare reform and the winter fuel allowance. That means she must find a further 7 billion, and she wishes to remove the child benefit cap, which caps benefits at 2 children, and that's going to cost 3 billion. So she needs to raise 30 billion is the assessment. So what's she going to do? Well, it's almost certain she's going to extend the freeze on income tax thresholds until the end of the parliament. So if inflation keeps rising and wage growth keeps rising, that will mean that income tax rates keep rising, and that will bring in more money. It's rumored to be about 20 billion. So that fills a large part of the hole. It's also anticipated to restrict the amount that employees can put into salary sacrifice schemes to just 2K before national insurance must be paid. There's rumours that she'll cut the amount you can put into ISAs. There's almost certainly going to be some form of a mansion tax, which will mainly hit Londoners. Rise in the dividend tax, question mark, gambling tax, question mark, milkshake tax. So the milkshake tax is she's going to end the exemption of milk-based drinks from the soft drinks tax and the tourism tax. The rumor is that there will be a tax on per head per night for hotels. Bottom line is your taxes are going up. Richard, any thoughts?
So I see this government on a desperate downward path to spot any part of the economy that it can ruin by taxing it more because it's so incompetent. And they are driving nails into the coffin lid of the economy with these absurd, futile tax increases. And I also think that effectively quite a lot of this tax is retrospective. So, taxing and putting VAT on school fees, people made decisions years ago that they wanted to educate their children privately. The rules were the rules, and they've changed the rules and said, now you're going to pay 20% more. People in London buy houses because that's what you have to pay to buy a house in London. They don't set out to say, I'm going to buy a house that costs so much money. They'd much rather buy one that's cheaper. They just don't have a choice. They bought it. And now they're going to be taxed on basically what is a necessity and an economic condition that meant they had to pay that much money. So, and a retrospective application of tax there. I just think it's shoddy. I think they're shoddy. I think they're stupid, and I think that they are ruining what's left of our economy. Basically, I really think it's bad.
We've got a piece coming up, actually, Richard, on yet again on generational wealth inequality. And I don't disagree with taxing houses. What I disagree with is the fact that it's a mansion tax rather than a broad-based tax. And also, where the money's going. The money should be going to addressing intergenerational wealth inequality, i.e., in my book, young people should be able to go to university for free again.
I completely agree, Chris. I mean, not addressing. So I have to agree. Fundamentally, I agree with the gambling tax.
Yeah.
I think they need to be very careful they don't destroy the horse racing industry. I mean, the problem with a lot of these things is a lot of businesses are actually running on quite narrow margins, and all of these tax increases, they have a huge economic effect. The wealth inequality gap is the generational wealth gap is intolerable as a consequence of many, many years of bad policy and needs to be addressed. I completely agree with you about student loan, but it's not going into free tertiary
No.
education for young people. It's going into welfare benefits
Yes.
for people who in many cases are perfectly capable of working but don't wish to work. People might think that's a rather extreme view, but and they still won't take off the bloody triple lock.
Yeah, I know. The triple lock is just an absolute disgrace. Right. Anyway, moving swiftly
I'll
on.
be done now,
We've
Keith.
got some positive stuff coming up later, he says. And on to equities, Richard.
Thank you, Keith. So, generally speaking, if you look down at the fortnightly change, all markets were down apart from the dollar index, which was up 0.5%. Year to date, however, all markets have been up, apart from the Bitcoin, which is now down 6% year to date, and the dollar, which isn't very much actually, and the dollar index, which is down 7.5% year to date. And Bitcoin basically in the last few weeks has reversed its meteoric climb in the first few months of the year.
Yeah.
I guess a number of people are coming to the stark realization that Bitcoin is actually not worth very much.
Well, we've got something coming up on that. Interesting.
Yeah. So FTSE World Index has had a good year.
Yeah.
The FTSE All Share Index has had a good year. So has the Stocks 600.
Yeah, but all of that came in the first 3 months of the year, basically.
Yes. Yeah, that's very true, Keith. Yeah. The S&P 500 up 12.3% for the year. Nasdaq Composite 15% for the year. Russell 2000 only 6.3% for the year.
And actually, the reason it's red is this chart is a 1 year window as opposed to since the start of the year, and it's down on a 1 year window.
Yeah. Hang Seng up nearly 30%.
Yeah. Amazing. Actually, one of the things this has really taught me is that there's a huge difference between the economy and the equity market. The Chinese economy is not doing great. UK economy is not doing great. We've got numbers coming up, but the equity markets have been fine.
Yeah. The topics up 18% for the year. There's Bitcoin, which we've discussed.
Mm.
And the pound up 4.5% for the year. And the euro up. Actually, the euro is quite strong against the dollar, isn't it? 11% for the year. And there's dollar index down 7.5%.
But it appears to have bottomed.
Yeah, I think so. The VIX spiked up over the last month or so, currently at 34.5, up 34.5. And US equity risk premiums are now in negative territory, have been for a while, really.
Yeah, it's amazing.
Seeing stocks safer than bonds. Well, they may well be right. Well, they may not be.
Well,
and the valuation of the overall valuation of the stock market, US market, is continuing to rise. Yeah.
Yeah. Well, it's probably come down a bit.
Yes.
A touch over the last 2 weeks, but still amazingly high.
Yeah. These are S&P 500 operating margins, which are pretty healthy.
Now, this is meant to be, in economic theory, this is meant to be mean reverting because you're meant to have competition. Yeah. But actually, what's happening is that you're not getting competition because you're getting huge tech monopolies, which are making supernormal profits for an extended period.
Yes. And markets are becoming more optimistic about 2026 earnings.
Yeah.
And that really, I suspect, reflects the fact that many people don't think that the US is going to go into recession. So investors are shorting non-profitable tech. What's interesting, isn't it? A big spike.
Yeah.
A short selling, a big spike there.
Yeah. So having lost confidence in this, short, big tech, unprofitable tech trade, they're now, back on.
And Morgan Stanley is agreeing with Simon W. that the equity market has a way to go yet.
Yeah, there's apropos our segment last week on the bubble issues. You know,
Yeah.
there's drawdowns quite normal in bull markets.
Yeah, to be honest, we haven't had a big drawdown.
No,
It's
we
been
haven't.
4%, isn't it?
Yeah,
Everyone gets so excited about it. When you look at it, you think when you draw the line underneath
yeah,
the price chart, and you just think, well, it's just just
yeah.
a bump.
Now,
So
yeah,
what's the big
exactly.
deal? Earnings expected to remain strong into end of 2025 and 2026.
Yeah,
The majority of the earnings, or all the earnings growth in 2026 is forecast to be coming from the Mag 7. At some point, the Mag 7 is going to fail to deliver. That is a sort of mathematical certainty. It'll be interesting to see what happens when that occurs.
yeah. So essentially, for the 493, the earnings estimates have been coming down. Growth estimates have been coming down.
Mag 7 market cap versus the rest of them.
It's not quite the rest, actually. It's like bottom 449, but
right.
it's getting there.
They couldn't quite fit in the other 44 or whatever. So there you go. Well, who knows what's going to happen, but are we going to have a rally, the Father Christmas rally, as it's known as, the Santa Claus rally?
Yeah.
The S&P is very slightly below its 50-day moving average. Hasn't been there since way back in May.
Yeah.
Goodness me.
Look at January last year.
Yeah, I mean, it's a nothing, isn't it?
It doesn't mean much, really.
It doesn't mean anything. Credit markets have turned down. So, obviously, for I think this is quite a short-term chart, isn't it?
It is. Yeah. But when you look at credit spreads on Oracle and CoreWeave and some of the big tech names, they're really coming off. Bond markets, who are meant to be more considered than equity markets, are worried about the AI bubble.
Yes. And over the past 4 weeks, there has been a certain amount of dumping, which is a technical term, of tech stocks, but not massive. Simply because the prices haven't fallen very far. So put volume suggests investors are a bit worried. We can understand that, but I suspect that they don't need to worry yet. My suspicion. And the number of US companies unable to cover their debt is rising. It's been high for a long time, though.
Yeah, and this depends how you describe this. If you say there are lots of startups, tech startups with negative earnings, that sounds positive. That's a growth story.
Yeah, and they raise equity, and that's fine. So, you need a little bit more of a detailed understanding of what's going on in their balance sheets. US households' aggregate financial allocation is now 52% to equity, which is much higher than it was 40 years ago. So these drawdowns will have a more significant effect on
precisely.
But they've done very well, of course.
They've done very well. Everyone's done very well. But, if they've kept on buying.
Berkshire Hathaway is still storing vast quantities of cash. I don't quite understand that strategy. I would never criticize Berkshire Hathaway because clearly they've done extraordinarily well, but I don't understand the strategy of holding so much cash.
Well, I think he's very disciplined. He only buys equities at certain valuations, and they've just gone beyond that.
Yeah.
So we've talked previously about these companies which convert themselves into basic Bitcoin treasuries, and the largest and best known of those is formerly called MicroStrategy, now called Strategy. It owns 638,000 Bitcoin, and it has an average price of 74,433. Now, it also has 6.2 billion of debt. So if the Bitcoin price falls substantially below its entry price, it is going to struggle to remain solvent. And then it will have to start dumping Bitcoin. And the market will really struggle to absorb 638,000 Bitcoin. So if the Bitcoin price falls below, let's say, 70,000, you could see it drop very rapidly after that on a deluge of selling.
Of course, it won't have to dump its Bitcoin, will it? But it will obviously be in a tricky financial position. And what then happens, I guess, depends upon it puts itself at, if it gets into this situation, it is then at the mercy of its lenders and of the trust
Yes.
in its loans and all sorts of things like that. But it's gone from hero to not quite so clever at the moment. We shall see.
Yeah. Yeah. Well, the thing is, when you think about the stock and flow of Bitcoin, you know, the now that Bitcoin is down, MicroStrategy and all these companies which just continually put a bid under the
Yeah,
Bitcoin price, they're going to struggle to keep on buying. If
yeah.
people start selling, who's going to buy?
I mean, I
Um,
think the other point here, Keith, which is that I suspect a lot of Bitcoin holders or buyers have bought on margin,
yeah,
and ones that bought on margin, over 100,000, are in a world of pain at the moment.
yeah.
So we don't know how much that is, but I suspect it's not insignificant. And there's that beautiful graph of Strategy Inc.
Yes, well, this is their bond price,
Ah, okay.
and the bond price is falling. So, markets, the danger is it's going to struggle to refinance its debt, etc. And if it goes bust, then the all those Bitcoin come onto the market. We'll
Yeah,
see. I mean, to my mind, when the market knows that there's a trigger, there's a hard line, like UK sterling in the ERM,
yeah.
you know, it
It's a
will
target.
test.
It's a
It's a
target,
target.
isn't it?
It's a
Yes.
target.
We shall see. I mean, basically, what this is saying is, although crypto market has come from nothing to being fairly significant in people's minds over the last 10 years, it actually is relatively small. And so
Mm.
a crash. It would probably disproportionately affect Donald Trump, actually. But um,
I think you'll be all right, mate. Okay, and while we talk about equities, let's briefly talk about Oracle. Now, you'll remember, and we've talked about it previously, how on September the 10th, Oracle announced this enormous deal with OpenAI, in which OpenAI committed to spending 300 billion over the next, I think, 5 years with Oracle. And that meant that Oracle committed to providing the computing power necessary to fulfill that deal, which means investing in 4.5 gigawatts of capacity starting in 2027. Now, initially, the market was very appreciative of that deal and its share price shot up. But since then, Oracle's share price has come off and is now below the price on that date. So this is Oracle's share price down 36% from peak. And problem for Oracle is it's committed to massive future capex. So it's the red bars, but fundamentally it's much less profitable than its peers. These are Oracle's capex commitments in blue, and you'll see that the next few years it is investing more than it's making in revenues, and those revenues are very backloaded. So they depend on OpenAI fulfilling its commitments. And so you see the gross profit is the dots, and its revenues from OpenAI will become the majority of its revenues according to this deal. And so the market essentially is expressing skepticism about whether this will actually happen. And as a result of these commitments, Oracle is now going to have 4 years of strongly negative cash flow.
This is a really dangerous deal for Oracle. And one of the
It is.
fundamental lessons of running a successful business is don't be over reliant on one or two customers. It
Yeah.
has basically magnificently rendered itself pretty much entirely reliant on OpenAI and OpenAI's performance.
Yeah.
And if OpenAI
Absolutely.
doesn't perform, it's screwed itself. It's
Yeah.
extraordinary. It's an extraordinarily dangerous thing to have done.
So bond investors are increasingly worried about the financial health of the company. This is the credit default swaps on Oracle. The insurance markets are charging more to insure Oracle
Well, they've
bonds.
doubled, haven't they?
And turning to the other party in this deal, this is OpenAI's revenue forecasts. So this year is forecast to make 13 billion. Bear in mind, so it's committed to spend 300 billion over the next 5 years with Oracle alone. And, it's forecasting its revenues will go up tenfold in the next 4 years. It's absolutely extraordinary. Now, it is losing money currently, and so it's got revenues, but it's losing money. And if the Wall Street Journal is right, although OpenAI does not report separately its quarterly revenue and its financial numbers, Microsoft does. Microsoft owns 27% of OpenAI. So you can work out from Microsoft's filings what the P&L on its OpenAI holdings are. And that implies that in Q3 alone, OpenAI lost 11.5 billion. Bear in mind, it's forecast to have revenues of 13 billion this year. And these are OpenAI's spending commitments, okay, of which its commitments to Oracle are just a part. So it's committed to spend 300 billion with Oracle, but its commitments to Amazon Web Services, Nvidia, etc., over the next 5 years add up to 1.15 trillion. Now, you can back out the revenues it will have to make to, at a minimum, meet those commitments. And if you assume it gets 70% gross margins, then it will have to be making the best part of $1 trillion a year to fund those commitments it's made. Now, can actually all these data centers that people have been committing to be delivered is a question. So these are 2 data centers in California which have been built, but which are standing idle because the local utility can't power them. Now, you'd think that's fairly basic. You wouldn't commit to building 2 enormous data centers without ensuring that the power is going to be there. But it shows that this sort of speculative building has gone too far. So can all these data centers actually be delivered? You can put them on paper, but can you power them? The market is increasingly skeptical about CoreWeave, which is one of these big data center providers. Its CDS is rising rapidly, and that implies a default risk of about 10% per annum. So bottom line is, OpenAI's contract commitments required to grow revenues from its current 13 billion in 2025 to a minimum of 980 billion by 2030. Richard, any thoughts?
And I think the point really is that it's sort of it's not this is not aspirational. It's got itself into a situation where contractually, if it doesn't, it's in trouble. And Oracle's got itself into a situation where it's not aspirational. It has to do it, or it's contractually, presumably, it's in, I don't know how far ahead it contracts its purchase of capital equipment, but the whole thing. I mean, the whole thing is predicated on an absolutely enormous rate of growth, and nothing can go wrong there. And I was actually just thinking, so I use AI. I don't pay for it because I'm cheapskate, I suppose. I use it a little bit. Obviously, when I do a Google search, I use it. I don't pay for it. I can't see me paying for it particularly. And there's going to have to be huge take up by business to start generating the size of revenue that these contracts depend upon. And all that revenue pretty much has to go to these few companies. There's no room for anyone else to come along and take a chunk of it. So I think, something is going to go wrong somewhere along the line. What and when and how big it'll be, I have no idea.
Well, I think you raise a very good point there, Richard, because if OpenAI is making $1 trillion, then presumably Claude and all the others are making a huge amount as well.
Yeah.
So it implies a vast allocation of money to AI, and currently it's all free. I mean, why pay for it? And it's like,
I mean, if you said that OpenAI is one of 5, for sake of argument, that'll make $1 trillion. Then you get 5 trillion revenues in a few years' time, which is currently like 20% of the size of the or 15% of the size of the US economy.
Yeah. Within 5 years.
In 5 years, yeah. Possibly.
And onto commodities. Now, I thought this was quite an interesting chart, which will warm Richard's heart. So this is the price of commodities relative to an emerging markets equity index. And you'll see commodities are dirt cheap. Now,
you could do this.
Yeah, sorry.
I was going to say you could cut this chart a number of ways. You could do commodities to the S&P.
Yeah.
You could do commodities to other commodities to gold. Mm-hmm. You can do oil to the S&P. They all look the same. They all look like the relative value of commodities has become far too low. And the only person I've come across who disagrees with this thesis is Doomberg.
Yes. Well, Doomberg would say that commodities always fall in price because humans are ingenious and the bounty of the earth is limitless. So far, since the 70s, that has been largely true.
Yeah.
But, we've got more on copper coming up. I don't think we're running out of headroom, frankly.
I think Doomberg is wrong. I mean, my view is he's wrong.
Yeah.
Also, as I have pointed out previously elsewhere, never believe in an anonymous chicken.
Particularly a green one. Oh, okay. So actually on this subject, Richard, quiz of the week. Here we go. In 1985, fossil fuels provided 67% of global electricity generation. Renewables provided 0, according to our world in data. In 2024, renewables and nuclear grew to a combined 41%. Okay, so that's good. Fossil fuels provided only 59%. So, since 1985, how much has fossil fuel demand risen or fallen? And this is just for electricity generation.
Is this a trick question, Keith?
No, go on. How much has it risen or fallen?
Well, it provided 67% of electricity, but how much electricity did we use in 1985? Much less, presumably.
Yeah.
It's doubled. I'll say it's doubled.
No, it's gone up by 450%.
So, okay, I was wrong.
So you're in the right direction.
Right direction. Yes, wrong quantum.
Here you go. Here you go. And this is the general point, and I think is your point as well, is that, we have got renewables and solar and wind, but they add to demand. They add to supply. They don't replace supply. Overall, electricity demand has just kept on rising, and with it, fossil fuel demand. So, and when we talk about the energy transition, it's not a transition. It's just additive. We've added a lot of solar and wind capacity, but we've kept on burning vast quantities of gas and coal. And frankly, when I look at this chart, when we talk about, COP26 or whatever it is, trying to reduce fossil fuel consumption, well, it ain't worked, frankly.
Mm.
So,
And it's not
yeah,
really going to work. I mean, it'd be lovely to live in a world where we didn't burn fossil fuels, but if we lived in that world now, there would be total social economic destruction, and we'd be back to the Stone Age.
yeah.
Literally, and so it's not achievable. It can't be done. So politicians have to get their head around reality, which is how do we clean the world up?
Yes.
And unfortunately, I think they've got their heads in the sand, thinking that there's a simple answer and it's build windmills and solar farms, and it's not true.
Well, to my mind, we just need to get rid of coal. That would just get rid of a lot of the problem. But
But then
we also need to invest a lot in nuclear.
exactly.
Um,
But to get rid of coal, you need to persuade the Chinese, don't you? I mean, China and
yeah,
India, I think, are the big. Actually, and Germany, of course, ironically.
yes, that's true. But when we talk about the future of oil demand, when you look at this chart, I see absolutely no reason to expect oil demand to peak. Things can change, but on current trends, I
Yeah.
don't see it. Before we get into the data, a quick summary. Energy markets generally weak, particularly oil on the prospect of peace in Ukraine. Industrial metals generally weak. Equity markets weak. Industrial metals markets weak, apart from tin, which has continued to rise. Precious metals weakish but resilient. Okay, so looking at energy markets, Brent was down 2.6% to 62.5, down 16% on the year. Great for inflation. WTI is down below 60 at 57.9, down 19% on the year. Great news in Europe is despite the cold snap, gas prices continue to fall, down 40% on the year. US natural gas prices, however, are resilient and up 26% on the year. Coal, flattish over the past couple of weeks, but down 11% on the year. Uranium, down a bit over the past couple of weeks, but up 4% on the year. And when you look at forecasts for how data centers in the US are going to be how their electricity is going to be supplied. Well, majority of it, frankly, is coming from gas and coal. So this is Brent. EIA is forecasting that oil prices will be below $60 next year. And I see no reason to think they're wrong. WTI is already below $60. Crude inventories are rising. Now, so in the oil market special I was saying how I was wary of oil market commentators because they always look at the data in the most positive way possible because they really want the oil price to go up. So here is Eric Nuttall saying, where is the oil glut? Global onshore oil inventories not rising. Well, that's because we know that the US has drained the SPR and they're not refilling it. But if you look at onshore plus oil on the water, then oil inventories are rising and rising rapidly. Now, turning to numbers specific to the oil market, we now have oil inventory numbers for October, and they rose by 25 million barrels. That's a lot. And the US crude inventories rose over the past couple of weeks by 1.1 million barrels, but they appear to be refilling the SPR a bit. US crude production, this is really important and amazing and surprising. So, US crude production has hit a new high. I was absolutely not expecting that. Up 183,000 barrels over the past couple of weeks and up 260,000 barrels over the course of the year. So I don't see, there's no evidence yet that shale is in decline. So I'm going to be watching this space to see when US oil production does start to decline. But right now, it looks like oil is definitely heading lower next year. The Baker Hughes rig count is picking up. EU natural gas futures, that's great for European industry and inflation. And the same is true in the UK. Despite this cold snap, gas prices are well down. US natural gas futures, though, they have highs for the year. Coal going nowhere, but seems to have stabilized. This is all you need to know about the energy transition. Look at Chinese coal consumption since 2000. It's massively shot up. So Richard is bullish on coal. There's no reason to think coal consumption is going to come down. Uranium, down a bit recently, but still up on the year. On to industrial metals, Richard.
Thanks, Keith. So, what have we got? Yeah, so I should say the most of the moves that last couple of weeks have been quite small. Lithium is powering away at the moment, up 14% and up 22%, nearly 23% for the year to date.
Yeah.
And the in terms of year to date changes, you've got aluminium, which is up 10%, cobalt, which has doubled but hasn't moved in the last couple of weeks. Copper is up, excuse me, it's quite volatile at the moment, copper, I think, but basically it's up 25% year to date, which is significant. And iron ore pretty much unchanged year to date. Neodymium up 40% year to date, but not moved much recently. And then nickel down 5%, tin up nearly 30%. And we have noticed before tin can be pretty volatile, can't it?
Well, tin is quite rare in the Earth's crust and, is difficult to substitute in electronics. So basically, there's a big bid under tin.
Yeah, and then zinc pretty much unchanged for the year. So they have aluminium, cobalt, copper, and copper demand. Projections are very strong, and the projections are that demand is significantly greater than supply will be. I think that means there's going to be a certain amount of substitution coming in with aluminium substituting for copper for some functions.
So it's saying that actually the copper market's been well supplied over the last couple of years.
Yeah. Of course, this year's been quite difficult because there's been a couple of large mines have gone offline, haven't there? There's been significant supply disruption. But there's massive decline in large-scale copper discoveries, and I think this is really the problem is that we don't know where the additional copper is going to come from that we need for the electrification of the world.
Yeah, this chart is all you need to know, really.
Yeah, and many new mines coming on at very low grades, which means the copper is very expensive to extract, very energy intensive to get out.
Yeah.
So there we have iron ore, lithium, which is gone up 50% since July.
Wow. I mean, that's quite a climb.
Yeah.
Bull market back on.
Yeah. Neodymium I think the Chinese have cut back production, haven't they, of lithium?
Right.
Because they're fed up with losing money on it, which makes sense. Nickel down 5% year to date. And there's tin, fairly steady climb, actually, if you ignore that April blip, which presumably was to do with tariffs. And zinc.
Yeah. Actually, that's a steady climb as well.
Yeah. So precious metals, sort of a bit of a nothing period for precious metals over the last few weeks. So gold and silver almost unchanged. Platinum down 3.5%, rhodium down 0.9%, palladium down 1.8%. But of course, year-to-date changes are very significantly
Enormous.
large.
Yeah.
There's gold, silver, platinum, rhodium, and palladium.
Yeah. All very good this year. On to rates. Thank you, Richard. Well, it's been thoroughly depressing in the UK, frankly, because the yield curve has shifted back up, thanks to Rachel Reeves and backing away from income tax rises. Now, I still firmly believe, I've been saying this for frankly years now, wrongly, that UK rates are going to have to come down because whatever she does, well, actually, this is not quite true, but hopefully, if she is fiscally prudent and does what she has committed to do, which is to meet her fiscal rules, then it means tax rises. And as you'll see, spoiler alert, all the UK data looks a bit rubbish, frankly. So she's going to be tightening the fiscal balance in an already weakening economy. So that will mean lower inflation, hopefully, and lower rates and lower sterling. Now, contrast the change in the UK yield curve. You'll see that it is up relative to a month ago and barely down relative to 6 months ago, versus the US, where it is well down relative to 6 months ago. Not great. And the thing is, markets are not concerned about inflation. So this is five-year forwards for the US and, 2.14%. They don't think inflation's resurgent. They're worried about government solvency, but governments seemingly defaulting rather than inflating away the debt. In the last year, markets have become less worried about the credit of the United States at a 5-year view, so that the premium they're charging to lend to the US at 5-year has fallen from 2% to 1.35%, but they're actually charging a bit more to lend for 30 years. So markets remain concerned about government solvency, and junk bond yields have been rising as equity markets have been selling off. So there's a bit of anxiety in the market. This is the UK 2-year. You'll notice it hasn't moved over the past couple of weeks. The 10-year, however, absolutely did, thanks to Rachel Reeves. And this is the 30-year. Still 5.4%. UK inflation is 3.6% and coming down. So you can get 1.8% real lending to the UK for 30 years. That's pretty good. This is the US 10-year. You'll see chart looks very different from the UK. You'll see that the whole market reaction to the news that Rachel Reeves would not be increasing income taxes led to just UK bond yields selling off. The US was unaffected. This is Germany, France, Italy looking much better than France or Germany. Greece, similar. Japan, down a bit today, but that is new highs, and that is likely to just keep on rising relentlessly. And onto this week's economic data. Before we get going, quick summary. What's changed is that the latest UK economic data is systematically weak. So it seems that previously we've been saying stagflation turning stagnation, but actually it looks like the UK economy is weakening. Inflation is coming down, but so is the economy, and that's before the budget, which will tend to weaken the economy further. EU still stagnation, US still fine, but the labour market, it does appear to be softening. China, actually, the latest data also shows the Chinese economy softening. UK, Richard.
Thank you, Keith. So, UK CPI month on month in October was 0.4%, and year on year is 3.6%. So, still too high and not under control. And core CPI month on month was 0.3%, and year on year was 3.4%. So not coming down.
Well, it is coming down, actually. That should have peaked.
Well, I think we have to wait and see, don't we? Because, in fact, if you sort of draw trend lines, it's still in that, I would say. Well, maybe it's not. Yeah, possibly right, Keith. Yeah.
It should have peaked for now. We've got some charts coming up.
Yeah. So RPI, which is the inflation measure that I always used to use,
yes.
And that is 4.3% year on year, and that is much too high. And I would suggest a truer, although not true, but a truer version of what we actually experience.
Yeah.
I was reading an article the other day that basically said whenever the inflation numbers are too high, the powers that be fiddle the calculation, so that they think that we're like frogs being boiled, and as long as we don't know we're being boiled, we're okay.
Yeah.
Service inflation in the UK at 4.5%, on a bit of a downward trend. Still
way too high, but the trend is good and is now resumed a steady downwards trend, having been persistently high for too long.
Yeah, household services and restaurants mostly responsible for the fall and food inflation continuing to rise.
Yeah, not great.
No. I'd say I haven't noticed that restaurant prices have fallen in October.
Well, they're so high already, Richard.
Exactly.
You probably cut down on the amount you're going out and sampling the prices. I certainly have.
Yeah, and this is contributions of various elements to inflation, and you can see there what the relative contributions are.
Yeah, but notice that housing and housing services are the largest contributor to inflation, and house price inflation is coming down. So hopefully that should bring that down.
Yes, true. And we're high by international standards, sadly.
Yeah, sadly.
And in NIESR is forecasting inflation will remain above 3% in April. And then it will drop on the dropping out of various elements of it. Who knows? I mean, it is. We've seen many of these graphs and they've never been right, but this one might be right.
Well, so the way this works, Richard, it's very, it's
very
mechanical,
simple, isn't it? Yeah.
It's very simple. So the grey line is adding 1% annualized inflation every month.
Yeah.
The blue line is 2%, black line 3%. And you'll see just from previous inflation dropping out of the comparison window, you should get UK inflation falling below 3% in April, because April was thanks to previous tax rises, was a big leap in UK inflation. But until then, inflation is going to stay high, and frankly, it's going to keep climbing again. So, if we're on track for 2% inflation, you'll now see UK inflation start to rise again into January. Not great.
So PPI month on month was down 0.3% in October. Year on year, it was up 0.5%. And output month output PPI month on month was unchanged in October and up 3.6% year on year, climbing.
Yeah.
Earnings growth, including bonuses, 4.8% in September.
Still way too high.
And excluding bonuses, 4.6%. So pretty much the same, really.
But, coming down, thankfully, but still too high.
Yeah. And currently the public sector is doing much better than the private sector in terms of pay increases.
Surprising absolutely nobody.
Yeah. And the main reason that earnings growth isn't coming down as fast as the Bank of England would like.
Yeah.
But fortunately, Rachel has what she calls her magic money tree, which means she doesn't need to worry about it. Because there's lots of broad shoulders out there.
Well, the broad shoulders are getting weighed down increasingly, Richard.
So 3 month unemployment, or 3 month employment change actually in September was down 32. Down 32,000. So first time we've had a negative number for since in the last 12 months.
Yeah, no, and this is really interesting because previously we were talking about how HMRC payrolls data showed the number of people on payroll declining, but the labour force survey had consistently shown employment growth. Now they're both in line.
Yeah. UK unemployment rate's 5% and steadily climbing from summer.
No, that is actually quite a big rise in the last 2 years.
Well, it is. Yeah. I mean, if you take beginning of 2024, shortly before Labour came into government, it's up 1 and a bit percent.
That's a lot of people.
And a steep climb. Payrolls change that Keith is referring to, negative.
Yeah. So finally, the HMRC payrolls data and the labour force survey data are in line.
But if you look at only for 1 month, Keith.
Yes, that's true. But if you look at the 12-month change in HMRC payrolls, that is a big drop. That's 164,000.
Yeah.
So the payrolls data is showing consistent falls in UK employment.
GDP growth in the UK, 0.1% in Q3. Wow, storming it.
Yeah.
And year on year, supposedly 1.3% in Q3. Okay, so September month on month was GDP growth was minus 0.1%, so it was actually down. And year on year, it was 1.1%. And there we have it.
Yeah. So actually, in the last 3 months, UK GDP on the monthly data is showing a decline.
So the two words tax and death come to mind, Keith. Linked by a 2-letter word.
Well, this is concerning. This looks like the UK's heading for a recession, frankly.
Yeah. Well done, Rachel. I mean, I don't want to preempt her triumph, but I want to be the first to congratulate her. Oh, and also UK business investment quarter on quarter down 0.3%, Q3.
Yeah.
And only 0.7 for the whole year. Productivity problem? It's not in business investment, is it? It's
well, if employment is falling, you'd hope labour productivity would be rising, ?
Yeah. Labour productivity, it's rising, Q3, 0.7%.
Yeah. That, frankly, is a truly, truly dreadful chart.
Isn't it just? Yeah. It's been flat, basically, for 5 years. UK construction orders, this is such a big change. You can't make much sense of it, can you? It's a seasonal variation, I guess. So it's easier to look at the chart, and you can see the chart's quite lumpy, and we've had a positive lump in September in Q3.
Yeah. Odd.
Yeah. Retail sales month on month down 1.1% in October, which is significantly worse than people are expecting. And year on year, retail sales up 0.2%. So basically, retail is stagnating.
Yep.
Industrial output down 2% in month on month and 2.5% year on year. And again, it's bad.
Yeah, not good.
Construction output down 2.5% year on year. Not good.
No.
UK balance of trade actually sort of trending in the right direction, but we need it to trend above that zero line now.
Well, to me, Richard, this is a sign of a weakening economy because the only time that we swing into a positive balance of trade is when the economy is doing really shit.
Yeah, we can't afford the imports.
Exactly.
And retail sales year on year 1.5%.
According to the British Retail Consortium, so slightly more positive than if you did that.
Yeah. CBI industrial orders looking ghastly.
Yeah, that's terrible.
Bottom end of its downward trend. Consumer confidence actually been flat for the last nearly 2 years.
Be interesting to see how this is after the budget, actually.
Yeah.
Watch this space.
Manufacturing PMIs just about 50.
Yeah, and actually surprisingly positive.
Mm.
I wonder if falling gas prices are improving the mood.
UK services PMIs falling.
Yeah, reminder, services about 80% of the UK economy. So this is much more relevant.
Yeah. And composite PMI sort of bouncing around.
Yeah.
Doing nothing exciting. House price balance down at -19. So that's currently dropping. And public sector borrowing requirement 17.4 billion in October. But
yeah.
September's good news was revised upwards slightly. There's a Citigroup Economics Price Index.
Yeah, it's dropped sharply as all the numbers are negative, have been poor.
Jobs postings from Indeed now starts very slightly starting to increase.
This is really interesting, actually, because I mean, all the employment data we showed earlier, terrible. But actually, job openings posted on Indeed are picking up.
Yeah, we'll have to see, won't we? UK wage growth falling on a downward trend.
So this is for jobs posted on Indeed. So that's good news, finally.
Yeah. Trueflation 2%. Don't believe it.
Well, let's hope directionally it's right.
Yeah. And falling UK house prices and rents are adding a bit of a disinflationary trend.
Yeah.
Well, we'll see.
I hope so.
Yeah. London house prices falling. I think that's probably because people are selling they're letting buy-to-let properties, aren't they? And fairly soon they'll be selling their home, the roof over their heads to avoid paying the so-called mansion tax. House prices elsewhere showing rises.
Yeah. So it's just a London thing, frankly. House prices are too high in London.
Yeah. But Rachel's got a plan to fix that. And UK inflation forecasts coming down.
Yeah. And actually, they're now lower than they were pre-pandemic. Interesting.
So this is Bank of England scenarios are very close to central forecast and are dwarfed by past forecasting errors. Can I just say, you read that, you saw that here first?
Yeah, well, exactly.
Bank of England inflation forecasting is a disaster area. So the rich are already making its massive contribution to public coffers, but Rachel says they've still got broad shoulders and it's going to squeeze them even more. And this is the share of tax. It's
absolutely astonishing. I thought 2% of the UK population are in the high rate band, but they provide 39% of tax revenues. Amazing. How much more can you squeeze them before they start?
Well, I think the problem is that this is it's like giving a sledge a kick down a snowy slope. It gets going very slowly, but once it's moving, you can't stop it. And it's just so foolish. They are so foolish.
Thank you to Discord member Lloydie Pool for sending us this table. Amazing.
Could we ask the Discord members from now on to send us only optimistic charts, please?
The trouble is, Richard, they've watched this podcast and they know we mainly have negative stuff.
Three-line whip.
We're British, it's only positive.
This looks like the inflation graph in reverse, doesn't it?
Oh God, yeah. I mean, the thing is, this dip in productivity just makes no sense to me. You can't think that's going to persist.
You have to hope it doesn't.
Well, the only thing I can think of is the transition away from high productivity oil and gas to low productivity renewables is part of it, but it's not that much.
Mm. Yeah, I don't know. UK residence-based emissions fell 60% between 1999 and 2025. Okay,
That's great.
that's good
Not very
news.
good, actually.
Yeah,
So, yeah, there you go. Some positive news, mate.
fantastic. So there's our summary. I won't bore you by reading it all over
Yeah.
again, but effectively, we ain't doing well. And what we actually need is a deregulation, cutting of taxation, freeing up of the economy, and ideally, all of the politicians everywhere to go away for 5 years.
Well, what was your overall impression of that data, Richard? To me, it seemed genuinely to be weakening.
Yeah, I would say it's very depressing, Keith. Yeah.
Yeah.
Because there's nothing good, there was no good news in it,
No.
apart from potentially was the rate of inflation slightly dropping. But in terms of economic activity, it's all looking pretty dismal.
Okay, and onto the EU. So GDP came through for 0.2% in Q3, which is not great. 0.8% annualized, but year on year, 1.4%. So not much better than the UK, frankly. Now, this is interesting. Negotiated wage growth year on year in the EU, absolutely collapsing back to pre-pandemic norms, 1.9%, massively below forecast. Stagnation returns to the EU. Industrial production actually ticked up in September, 1.2% year on year. Construction output, this was a big miss, down 0.3% year on year in September. Manufacturing PMI around 50. Services PMI actually strengthening, and that looks all right. 53.1. So the composite 52.4. Weak, but not too bad, frankly. Consumer confidence going nowhere, still gloomy. Balance of trade positive. The EU pays its way in the world. Economic surprise index still positive. Like the UK, I thought this was really interesting. It looks like that online job postings have hit a bottom, stabilized, and now starting to head back up. Wage growth, 3.6%. It's all right. Even France has had a little tick up, but French wage growth anemic, 1.9%. So EU summary, stagnation, but no sign of recession, I would say. Unlike the UK, the services PMIs are resilient.
Mm.
Richard, on to the US.
Thanks, Keith. US non-farm payrolls, 119,000 in September, looking good. There's a breakdown of non-farm payrolls, which is quite complicated to read.
Yeah, but the point for me is that construction, which is a key forecaster of the economic cycle, continues to add jobs. But although non-farm payrolls was surprisingly positive, that was because they changed the seasonal adjustment factor. So this is the seasonal adjustment factor for September in every year going back to 2020. And you'll see the 2025 one is much lower. And hence, the non-farm payrolls report was more positive than it should be, it would otherwise have been. And we'll show you in a sec, the unemployment rate rose. So if the US economy is doing so well, why does the unemployment rate continue to rise? Question mark. Richard?
So there we have the ADP employment change, which is, as Keith just says, suggesting a softening of the US jobs market. So average hourly earnings up 2.7. Average hourly earnings month on month up 0.2% September, 3.8% year on year, continuing their decline. US unemployment rate just moving up ever so slightly, 4.4%. Is the rise in unemployment due to an increase in the size of the labour force?
Yeah. So we've had a decent size increase in the size of the labour force in the last 2 months.
Yeah. The US unemployment rate is 8% in September.
Yeah, this is U6. So this includes discouraged workers.
Yeah. Weekly hours worked, 34.2.
Yeah, which is still weak, actually.
Yeah. And the small business optimism survey, 98%, which is actually doing relatively well.
Yeah, absolutely. It's all right.
Construction spending up 0.2%, so that's been positive for the last 3 months. Factory orders positive, 1.4% up in August.
Yeah, still good.
Manufacturing PMI is at 52, so still on that sort of gentle upward path.
Yeah.
Services PMI is 55, so quite healthy.
That's a very healthy number. There's no, the US economy is doing just fine, according to that.
Composite PMI nearly 55, and that's looking nice, healthy as well. The housing index is at 38, so it's declining gently, but there's nothing significantly different there to the previous few months. Existing home sales still low, but stably low at 4.1 million.
Mm.
Initial jobless claims falling back a bit to 220.
Yep, so no rise in initial weekly claims. I should say that this has all been backfilled now that the shutdown has ended. We got a big data dump of 6 weeks data.
Yeah. Continuing jobless claims actually rising a bit, nearly 2 million.
Yeah, but still not, when you look at it over the course of the last 6 months, not really much of a rise, frankly.
No. The top end of its range. Warn notices for large layoffs are rising, so more layoffs seem to be in the pipeline.
Yeah.
Indeed, job postings index, make of that what you will, it's probably still on a downtrend. Indeed, wage growth is definitely still on a downtrend.
Mm.
And jobs postings are falling.
Although if you look at the right-hand chart,
fairly flat.
Stabilized, yeah.
Yeah. And the Dallas Economic Weekly GDP estimate 2.3%.
Fine.
Atlanta is 4.2%, which is quite high.
Yeah, almost certainly too high, but still the trend is good.
New York is 2.3%.
Yeah, we like this one.
And St. Louis is 0.48%, which is at the lower end of its series.
Mm.
And Goldman are remaining bullish on the economy with growth of 2.5% next year. And as a Citigroup Economic Surprise Index, which is a bit positive. US Trueflation, 2.4%. Yeah, rising on a right upward trend still.
Yeah, but not particularly elevated.
And using real-time market data, then core CPI would be lower than it has been between 2012 and 2020. So that is a positive look.
Yes, it is.
Inflation rate.
So it's saying that basically historic shelter is still skewing inflation to the upside.
Yeah. National rent growth is still falling, bringing OER down.
So that's good news for future inflation.
And the price of a new home is lower than the price of an existing home for the first time since 1971, which may be bad news for builders.
Yeah, but still, construction activity continues to rise, mainly on data centers, to be fair. But, this is surely bad for builders' margins. We've previously had that chart of housing inventory, which
Yeah,
has been rising. Well, there you go. They're trying to shift it.
yes, quite possibly so, Keith. US trade deficit in goods and services is bigger in the first 8 months of 2025 than it was in the first 8 months of 2024. So as yet, tariffs have not reduced the trade deficit.
Yeah. It's a sign of a good, strong economy, though.
Yeah. So a chart showing wealth inequality in the US. So top the top 10% have 36% of the wealth. Top 1% have 30% of the wealth. Bottom 50% have about 3% of the wealth.
Yeah. It's a shocking number.
Yeah. And share of household net worth, top 50%, 98-ish, bottom 50%. I don't know, what's that? 3%.
2% or something.
2%, yeah. So the rich are feeling more positive than the poor, which isn't surprising, is it?
Yeah. Oh, frankly, they're not feeling that good. I mean, that's surprised
No,
by
they're not.
how
They're
little
all
difference
feeling pretty rubbish, aren't they? It's just that
Yeah.
the rich are feeling
Yeah.
less rubbish than the poor.
Yeah.
So the number of construction projects in the planning process has spiked dramatically in 2025.
Yeah.
Which is
Wow.
interesting.
That's very interesting. So there's presume that's a lot of data centers
Mm,
being built. So that's positive for the US economy.
yeah.
If it was in the UK, they could apply as much as they like, but where they'd get
Well,
you
the other thing, if it was in the UK, Keith, we would have to tax it.
well, just the planning process. I'm
Yeah,
sure that
yeah.
gets taxed as well, which
Yeah, have to tax the planning process because they've got broad shoulders. If they've got enough money to put in a planning application, their shoulders are broad.
yeah.
CapEx have been revised dramatically higher. I mean, it's obviously to do with AI, and we'll wait and see whether they can actually continue to have CapEx at that scale. We shall see.
Well, look at the dark blue line. The increase in estimates for CapEx is astonishing.
And lower income budgets, as we know, disproportionately go to food. And
Yeah.
the problem there is that food inflation isn't really going away. Certainly, it's not in the UK. Well, obviously, the same thing prevails here. So,
Yeah.
I guess in summary, the US economy is looking pretty good, and I think the AI, obviously, AI is having a significant positive impact on the US economy. It's the labour market slowing a little bit. No sign of it moving into recession.
Agreed. On to China. So generally, the Chinese data is all quite weak. So this is new bank loans. That was well below expectations and well down on September. Outstanding loan growth continuing to drop. So this is further evidence that the Chinese are moving away from an investment-led economic model. Money supply growth, better than expectations, but down on September. It's still very healthy, frankly. Inflation is back in positive territory, but not much going on. House prices are continuing to fall at 2.2% per annum, and they've been falling now for pretty much 3 years. Industrial production growing at 4.9% year on year, well down on September and below expectations. Retail sales, better than expectations, but still down on September. Fixed asset investment, down 1.7% year on year, much worse than expected. Foreign direct investment has been falling for 2 years now, and actually quite substantial falls in that period. Bottom line, all that data I think you'll see has been tended to be quite weak. Is the Chinese economy slowing down? Obviously, how much you can rely on that data is an open question. And onto one chart. So this is the auction clearing price for electricity in the US. And this is the price for large customers. So electricity prices in the US are forecast to keep rising if all those data centers get built, and that is bullish for natural gas in particular, but also for coal.
Okay, so now we're going to have a little look at generational income inequality.
So this is just how different generations are defined. So Richard, so I'm Generation X. Which you are Generation X as well, Richard?
I'm a baby boomer, Keith.
All right. So I didn't realize Generation Z was 1997 to 2012. They're quite odd kind of periods, this.
Yeah.
Like, why 19? You'd think they'd be
They are,
out
they're
and
in fact
nine.
sort of 15-year periods, aren't they?
Right. Yeah.
From 65 onwards.
Yeah. So I don't know who defines these anyway.
Uh,
So when you look at like spending growth, like based on credit and debit cards, what you see is that the millennials have actually had declining spending growth over the last couple of years, and Gen Z has had rising spending growth. But that's because they're essentially entering the workforce. And so
yeah,
they have rapidly growing wages as they develop their skills. But young people in employment have seen actually declining spending. So the people who are doing well in the US economy are the baby boomers and Gen X. Sorry, and what am I?
not Gen X,
I'm
Keith.
Gen X. Actually, Gen X isn't doing very well either. It's the
Should work,
baby boomers,
Keith, you
etc.
need to work harder.
Yeah, that is true. Actually, working harder has not done me any good over the last couple of years. I need to work less. And when you look at the age at which US citizens buy their first home, this is an astonishing chart, and it shows the effect of the pandemic QE on house prices and housing affordability.
Yeah,
So prior to the pandemic, it was 33, which is already high. It is
yeah.
now 40.
And this is all down to QE,
Yes.
the lunacy of the central bankers in the early 2000s.
Yeah, absolutely.
And
Asset prices are sticky on the way down. House prices.
yeah, and the consequences of their actions. And the fact, what frustrates me is nobody's pointing, nobody really is nobody challenged them.
Yeah.
They were elevated to the level of gods, or they actually elevated themselves to the level of gods, I suspect. And they then set themselves up as being unchallengeable, and they have caused. This is the same in the UK as it is in the US,
Yeah.
but they've caused irrevocable and really serious damage to the social fabric,
Yeah, no, I
and not
agree.
being held accountable. Which is why, in my view, we don't need central banks, because they're incredibly dangerous and they are not electable. They
Well, the
are
thing is,
appointed.
I disagree, Richard. I think we do need central banks because in order to avoid recessions, because when there's a financial panic, such as in 2008, then the market will is an emotional beast and will set interest rates ludicrously high, and you need a central bank to actually get them down.
So you have a fair point there, Keith. So what we need is a system where central banks are under far greater political control. I'm not saying that political control is good, but at
No.
least political control is, in a democracy, it is elected, whereas what we have with the central bankers is an unelected elite doing things like this,
Yeah.
which is
Well,
not acceptable.
the trouble is, Richard, when interest rates were under electoral control, like as they were in this country until the Brown government, what was that, 1997 or something, 2000, then the governments would cut interest rates just before an election, you know.
There's no
So,
right answer, is there, Keith?
no.
Benign autocracy with you and I in charge.
Buy gold seems to be the correct answer, actually. Um, so first time buyers are increasingly priced out of the market. Only
Yeah.
21% of all home buyers are first time buyers, which is perfectly compatible with that 40 being the first time
Yeah.
you can buy a house.
Yeah.
And that's all been caused by sky high house prices. Look at that. Since 2021, US house prices are up 50%.
And it can't be corrected because if it were to correct, as opposed to stay flat for 17 years, if it were to actually correct, it would crash the economy
Well,
because of all the debt.
yeah. Well, interest rates are up. You'd expect this to be having an effect on housing transactions and the construction market, which it
Yeah.
is, but is being
Yeah.
offset by AI investment.
Yeah.
So the combination of very high house prices and higher interest rates means housing affordability is bloody awful. Median house price payments percentage of median income, 47%. So this is the flip side of those big fiscal deficits. Higher interest rates mean, which are good for creditors, bad for debtors, and young people are debtors. They need to borrow to buy houses.
Yeah.
And this is the affordability gap. So in order to get a mortgage from Freddie Mae or Fannie Mac, you need to be getting an income of $125,000 a year, whereas the actual median income is about 80, so you can't get a mortgage. And youth unemployment is consistently higher than total unemployment. So youth unemployment is now 10.7%. Overall US unemployment is 4.3%. So this is a particular problem in the UK, actually. As you increase the barriers to employment, so the Labour Rights Bill, where the UK is now going to
Mm.
get rid of probationary periods, which will increase the friction of hiring and firing workers. That is very bad for young people because it stops them getting hired. It keeps old people in jobs.
So my bet, Keith, is that the workers' rights bill will in fact increase productivity.
Will increase productivity. Yes, it
Will
could do.
increase productivity, yeah,
Yeah.
because businesses will find ways to make their existing staff stretch further.
Yeah, I think that's true, but bad for young people.
Bad for young people. Yeah.
So US graduate unemployment is now higher than during the GFC. And these people, the young people, have taken on a huge amount of debt to get where they are.
Yeah.
Credit card defaults, highest for 18 to 29-year-olds. So signs that they're under financial stress. That is a very disappointing chart. There you go. This is an absolutely shocking chart. So under 40s is the dark grey bar. That is stock market wealth. Over 70s have got it, got stock market holdings. They've done amazingly well. But the vast majority of stock market wealth in the US is held by people 55 and older. Young people
Mm.
have done very badly out of the housing bubble and the stock market bubble. And as a result, this is a very depressing chart. This is the number of people, the number of young people, 2024, not in work, not seeking work, not studying, not raising children. They're just demotivated. And you can understand it. They feel that the economy is not working for them and they don't have a hope. So far, there's been no political unrest about this. But, frankly, you feel there should be. So at the end of all that, I am left feeling actually, you know, mansion taxes, well, I think there should be taxes on property, basically, but we should be encouraging, helping young people get a foothold in society.
Yeah. So my solution obviously is a very complex issue, but my simplistic solution is that student loans for tertiary education should go.
Yeah.
That education of young people should be paid for by society. The triple lock needs to go.
It does.
They are too overtly skewing things that were fundamentally disastrous, introduced by effectively Tony Blair and David Cameron, respectively. And then a lot of barriers to economic growth need to be slashed away, including the taxation system. And I would go back to actually Liz Truss's concept for the taxation system, I think was right. Her execution was appalling. But the concept of reducing taxation, encouraging people off benefits and back into work, and then a steady, stable simplification of regulation and the taxation system, and leave it for 10 years and let it all settle down.
Yeah.
And I think if you do those things, fundamentally, the economy would move to a different equilibrium. What we actually have is politicians constantly stirring the pot and wanting things to work in weeks and months, and it doesn't happen that way. And they're not addressing the big fundamental issues. I shall now step off my hobby horse.
Well, the thing is, Richard, I look at it from a slightly different angle. I mean, see, the last 20 years, I think what you're seeing is the UK polity rewarding an aging population. So, Tony Blair are taxing that, making students pay for their education, and then the Tories putting in the triple lock. It's the gerontocracy. It's like giving sweeties to elderly voters at the expense of the young.
Yeah, completely agree, Keith. It was utterly appalling. Okay, let's have a little look at crypto exchanges. So crypto exchange leverage, they commonly allow you to take leverage bets of 10 times or up to 100 times. That's a particular amount of money I could have made, Keith, if I'd taken 100 times bet on Bitcoin.
Well, I don't think you could, Richard, because read on.
So this is a good example. 10 times leverage bet. Keith here, he's being careful with his money. He's only taking a 10 time leverage bet on Dogecoin or Doggycoin. I think actually the pronunciation is Doggycoin because there's a dog on the front of it. Then you have £1,000 exposure to Doggycoin, and the exchange lends you £900.
Yeah.
And on which you pay interest, probably 4 or 5%. But the exchange has this credit exposure, and you are you are not typically liable for the losses in excess of your deposit. How does that work?
Well, here we go.
Qcoin. Okay, I'll sign up for that, Keith, if you could.
100 times leverage, mate.
I'm in. So it avoids funding the additional 900 of exposure by not actually buying the dodgy coin. I'm going to call it dodgy coin from now on.
Yeah.
Instead, it finds a matching short trade. Yeah. So there we are. We're two punters, Keith. I'm going to be the seller, if you don't mind.
I do mind. I think we both want to be sellers.
So the exchange is going to match our two bets, and punters. My trade, where I've been persuaded to buy dodgy coin by Keith, who twisted my arm, and Keith unfortunately has only partially filled his trade. So the exchange is not actually trading any dodgy coin at all. It's a bookmaker, not a market maker. Right.
Yeah.
So I owe Keith actually £1,000, don't I?
Yes, that's right. Well, we owe each other depending on the direction.
Well, I'm assuming dodgy coin is going to go to zero. Yeah. I'm starting to make an assumption there. So dodgy coin dips, not plunges, it dips 20%.
Yeah. I
have lost my £200 and Keith has won £200. So I only have £100 though. So I've lost £100. Keith gains my £100 and another £100 which is owed to him by the exchange.
Yeah,
but not by me.
Exactly.
Well, I owe the. Do I owe the exchange £100?
Apparently not. No, this is the whole point. You don't. There's like non-recourse. They can't go after you for anything more than the amount you've deposited.
So 100 times bet sounds like a good deal to me, because your trade-off is, if you think you've got directionality right, your trade-off is enormous. Your payoff, your expected outcome is very positive
Yeah.
at the cost of someone else's. So the exchange manages its risk by auto deleveraging and closes the trade the moment it is exposed to losses. So you have no choice.
Yeah, exactly.
We've got the same situation with me being punter A, Keith being punter B. I can get wiped out and the exchange closes the trade. Punter B does not get all the profits that he expects because his position is closed.
Yes, that's right.
So yes, so the winners subsidise the exchange to avoid taking losses, which works as long as it can close the position. Well, it can close the position because it never owns the physical asset. Well, not physical asset. It
Yes,
never
that's right.
owns the asset.
It's got nothing to trade in the market. It just simply closes it out.
So these people, the punters with the massive leverage bets, will get wiped out, and their trades are also deleveraged,
Mhm.
and arbitrageurs are no longer hedged and have to sell their physical holdings, which falls a further, basically a waterfall effect, isn't it?
It is, yeah. Essentially, yeah. So you can't reliably hedge. So as Bitcoin price falls and you can't hedge, you need to just get out, which could cause a cascade of selling. And that
So
cascade of selling can cause self-reinforcing falls in Bitcoin.
it's a bit like a three-dimensional Ponzi scheme, isn't it?
Yeah, absolutely.
That's interesting, Keith.
And it gets better.
Go on.
So all punters want to buy and sell Bitcoin all the time. And as you've seen, trying to match all these trades is difficult. It would mean that actually they'd have to accept far fewer trades than they wanted to, than is available. Therefore, the reality is most exchanges actually do take some exposure to the market. So they will take some of the other side of all these trades. Now, that is a problem if the market is trading relentlessly one way, as the Bitcoin has. So, you know, punters all want to be long. The exchange actually ends up accepting some of these trades naked short on the other side. So, under that situation, Bitcoin keeps on rising. The punters make money. The exchange loses money. But there is a solution as old as time called the bucket shop drive. Now, let's suppose that in these illiquid markets, the exchange has a glitch so that for 1 minute, it only accepts sell orders, not buy orders. The price drops rapidly. All those punters who are long and have only got a certain amount of cash with the exchange, they get automatically stopped out at their limit loss, losing money. The exchange makes a lot of money, and the price then goes back to normal. There you go. The more illiquid your shitcoin, the more likely you are to get taken out by the exchange.
Okay.
Yeah.
Oh, I mean, yeah. So it's like extraordinary, isn't it? I didn't realise this.
Well, this is, if you ever read Reminiscence of a Stock Operator,
Yeah,
basically crypto exchanges have reinvented the bucket shop. So essentially, crypto land is the unregulated Wild West. Don't mess around with that
yeah.
stuff. There's no value there. Actually, you all know that, but anyway, it's interesting. Okay, and now thank you. We're going to do this. This is thank you very much to Andy, who is a regular viewer, and there's been so much going on. I haven't had a chance to actually do this for the last couple of episodes, but he sent this through talking about the Treasury market and the basis trade. So let's start by going through Treasury market instability back in March 2020. Now, Do you remember? This was during the pandemic, and there was a dash to cash in March 2020. There was massive deleveraging in all markets, and that led to extraordinary volatility in global bond markets, including in the US Treasury market, which is the largest market in the world. So this is 10-year bond yields in the US, light blue, and you can see bond yields collapsed as people rushed for safety and then spiked higher and then settled down. So bond yields fell initially as investors rushed for safe havens, but then when they got margin calls from their equity positions, they needed to sell those safe havens, and that caused bond yields to rise again. Um, but all that buying and selling overwhelmed liquidity in the market, leading to not only extraordinary volatility, but also a rise in the bid-offer spread. So too many people wanting to trade in the same direction, overwhelming market liquidity. So the moves in bid-ask spreads were extraordinary. Look at that. Going from an average of 0.2% to the best part of 1%. Very good for investment banks if you're willing to take the other side. So this was only solved by Fed intervention. The Fed stepped into the market and bought $360 billion worth of treasuries. And it also committed to purchase agency mortgage-backed securities, etc., in whatever size was necessary to ensure that the market was functioning properly. So let's talk about the basis trade, which is one of the games that hedge funds play in enormous size with enormous leverage in the US Treasury market. So the background to this, and one of the reasons the basis trade is concerned, is that banks are playing much less of an intermediary role in the Treasury market. So after the GFC, the Basel III regulations on banks came into effect, which essentially placed limits on leverage. And as a result, banks became more careful in their capital allocations and only allocated capital to their most profitable activities. So bank capital has risen since the GFC, but it has not kept pace with the enormous rise in public debt. And if we assume that the ratio of bank capital divided by public debt is a proxy for the availability of bank capital to intermediate in the bond market, you can see, according to the y-axis, that the ratio has been falling. Banks are less willing and less able to allocate capital to market making in the bond market. And so you'll see primary dealer transactions on this chart have fallen from around 14% of trades pre-GFC to around 3% now, and that is a steadily falling chart. Treasury market liquidity is lower than it used to be and has changed from being led by banks and market makers to shifting to a technology heavy and asset light approach. So what is the basis trade? Okay, so in order to understand the basis trade, you need to understand that Treasury futures are different from most other financial futures. So if you're talking about, let's say, a copper future, then the copper future will define the deliverable very clearly. So it will say that it is, 1 ton of copper delivered to the LME or the CME on a particular date, and it has to be a particular purity. Treasury futures are defined on a basket of deliverables. Any one of the bonds in that basket can be delivered to the purchaser of the future on the expiry of the future. So if you look at this table and look at the 5-year note, then any bond in the defined basket of deliverable bonds can be delivered on the expiry of that future, and those bonds will have a maturity between 4 1/6 or 5 1/4 years. So you don't know which bond you will get on expiry of that future. It could have any maturity between 4 1/6 and 5 1/4 years. Now, the reason this system exists is to limit the risk that the seller of the future will be unable to fulfill its obligations on the expiry of the future by delivering a particular bond. They can deliver any bond within that basket. And of the bonds which is possible to deliver on the expiry of the future, there's always one that is going to be the cheapest to deliver for the seller of the future. And the basis trade is essentially the arbitrage between the price of the future and the price of the cheapest to deliver bond. And this is how you can calculate the cheapest to deliver bond. I'm not going to go into the details. Please pause and have a read of this text if you're interested. Okay, so how does the basis trade work? Well, the hedge fund is selling the future and buying the cheapest to deliver bond. But it can then use that bond it has bought as collateral in the repo market for a loan, which provides it with cash to repeat the whole thing. So it's able to leverage this trade up by a lot. And when it comes to closing that trade, it does the whole thing in reverse. So it buys back its Treasury future, it sells its Treasury bill in the cash market, receiving cash back, by which so it can then undo its repo transaction and unwind the whole thing. Now, the reason we're doing this segment is that our viewer Andy sent us this chart. So previously, the US Treasury had apparently been unaware of the size of holdings of US Treasuries by hedge funds based in the Cayman Islands. And so hedge funds based in the Cayman Islands have about 1.4 trillion of US Treasuries as of the end of 2024. So that means that the basis trade is vastly bigger than the market had previously anticipated. And the danger is that if, for whatever reason, there is a forced deleveraging, because banks have stepped back from their role in market making, that any forced deleveraging would result in massive sales of treasuries in the market, leading to a swamping of liquidity, gyrations in the treasury market, the blowing out of spreads, volatility, and the Fed having to intervene once again. So you'll notice this segment is slightly different than the others because I was unhappy with my explanation earlier, so I've re-recorded it. But I hope that is clear.
So inflation watch, we have the table of what's going on. So UK CPI at 3.6% in October was down. Core CPI was also down at 3.4%, and RPI at 4.3% was down. Our interest rate is 4%. And supposedly we're doing QT. I'm not sure whether we really are anymore, are we?
That's a good point, actually. I will issue a correction or not.
For the EU, it was CPI was up to 2.1% in October. Core was unchanged in October, and interest rate is 2.15%. And they're doing TPI. I can't remember what TPI stands for.
Transmission protection instrument. So basically, they're forcing the bond yields, buying the bonds of the periphery, or stopping
Oh,
the
you mean we've got yield rate suppression?
yes, exactly.
Yield
That's what the
suppression.
EU is doing.
Yeah. Well, so Japan, CPI 3% in October, which is remarkably different from what they had a few years ago, isn't it? And 3%
Cheers.
for core in
Yeah.
October, interest rate is 0.5%, and China 0.2% CPI in October, 1.2 for core, very low indeed, and prime rate 3.1%.
So,
Japan just starting QE.
well, Japan has endless QE, as you know, but it's
Just
like
actually starting a
UK.
bit more.
Yeah, slightly a bit more. The UK inflation is coming down. Everywhere else, inflation is not coming down. Okay, so quickly on to recession watch. So residential construction employment in the US is starting to fall, although construction employment is not, thanks to AI. And the number of housing units under construction has been falling for quite a long time now. So this is a very puzzling chart. The number of houses has been falling for like 2 years, but the industry's been employing more people at that time. Lots of lags in the process. Used vehicle inventories are rising, so people are struggling to buy second-hand vehicles. And further evidence of that is that auto loan delinquencies for subprime borrowers have hit an all-time high, higher than during the GFC. You know, poor people in the US are not doing well, and that's further evidenced by the share prices of US used car dealers doing badly. Student loan delinquencies have shot up. It's interesting that it's people with who are 50 plus leading the loan delinquencies in the US, and credit card and auto loan delinquency rates are rising again. I thought this was really interesting, actually. 12.4% of US credit card balances are now 90 plus days in delinquency. That is a big number. 12.4%.
It is, isn't
That's
it? Yeah.
that's big. The freight industry in the US is already in quite a deep recession, I'd say. I mean, that is a really bad number.
Mm.
You're looking at the left-hand chart here, but private credit ETF in the US has already fallen about 30%. There were problems developing in private credit, or the market thinks they are. Bankruptcy filings remain elevated. And these are Chapter 11 filings in the US. They're up 20% year on year. That's quite big. So the average US consumer is struggling, but the US economy is doing just fine because actually we know that poor people have very little money. So
Mm.
actually most of the spending is from rich people. So when you look at the averages, it's a bit misleading. What you want to be looking, if you want to look how the economy's doing, you want to be looking at how well off people are doing. And on to good news. So here you go. The NHS now prescribes fishing for anxiety and depression. That foreigners will be watching this thinking, what does the NHS not do? So Tackling Minds is a charity staffed by volunteers who take patients out for fishing. So far, they've helped about 2,300 people. I mean, to me, this is just like, let's get you away from your wife for a day, improve your anxiety and depression. Anyway, moving swiftly on. Concluding comments. Ah, God, what do you think, Richard? Market's having a wobble, but they had a great run. It's not
Yeah,
developed
I
anything
think that's the point,
significant.
isn't it? They've had a wobble. They may still be in the middle of having a wobble, but the wobble is so far, it's just a wobble. It's nothing much, nothing.
Yeah, but I would
Despite,
say some of the air is coming out of the omni bubble. So crypto is definitely crashing.
yeah,
Meme stocks are having a bad moment.
yeah,
Credit markets are really important. Credit markets seem to be have um they have stopped being so complacent about AI risks.
yeah.
Quickly onto my portfolio. Well, this week the two UK listed REITs announced a merger. HICL, which is Infrastructure Trust, and TRIG, which is the Infrastructure Trust, announced a merger. They both share the same investment manager. There are no synergies. Why were they doing this? Just to create a bigger trust. Now, the market did not take this well. So shares in HICL fell sharply, about 7% on the day, and shares in Trig rose but then fell back. So, net net, the market did not like this deal. Let's see if they manage to get it past shareholders. Now, two of my, so I did a trade this week. So, this is VH Global Energy Infrastructure Fund, which I've talked about previously. It has renewable energy assets all around the world, none in the UK, so it's not exposed to the UK government's shenanigans with the renewable obligation certificates. This is its latest quarterly report, and it was fantastic, I thought. So its NAV rose by 6%. Its share price is currently 60.3p. Its NAV is now 106.7. So it's aiming to wind itself up because the clearly the market does not appreciate renewable energy trusts anymore. And if it were to wind itself up at or close to NAV, then you're looking at potential upside of the best part of 80%, and it's yielding 9.5%. So there you go. Current dividend yield. Actually, its share price has risen a bit now. So it's only yielding 9.5%. But, 43% discount to NAV, NAV rising. At the other end of the scale was Foresight's Solar Fund Limited, which is a total disaster. In a quarter, its NAV fell by 6%. Now you'll notice, including in the NAV, is time value, and that is the discounted value of future cash flows. So the NAV basically includes itself, its value for future value. So the NAV is going to be declining as it steadily consumes its future cash flows. And it's been a total disaster. So I sold it. Sold it at a big loss, 27%, yielding 12.4%, but I see very limited upside. Whereas the other one, ENRG, I see big upside. And last item this week, well, last time I told you I was going to buy some oil company. I was going to buy some PetroTal.
Mm.
Well, I did. So last Monday before last, its share price was 36.5p, and I put in a limit order at 35p. On the Tuesday morning, it announced it was eliminating the dividend to preserve cash while it executes its field development plan. The shares fell 33%. I got filled at 32. The shares now trade at 21.2p. This is the
Gosh.
danger with limit orders. I mean, frankly, everything I touch at the moment turns to lead. But medium term, it's got very good assets. The reason it's cutting the dividend is because it wants to have a minimum of $60 million in the bank, and it thinks he's going to be spend so much on the field development plan that that could endanger that. But that means in due course, those fields will come into operation and it will be all right.
I mean, it's a
So,
very sensible thing for it to do, isn't it? But obviously, the
yeah,
shares took a knock.
the shares took a knock. So at the moment, anything I say, just wait a few years before following me. Anyway, so on that note, thank you very much for watching. We'll do another one of these next week because after that I'm off skiing. And it's goodbye. So thank you for watching. Please subscribe to the channel and the other one. Press like or something. Yes. But it's goodbye from Richard Wheater.
It's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.